Good afternoon and welcome to the Perennial Live webinar for the launch of the Perennial Private to Public Opportunities Fund for wholesale investors only. My name is Caesar Farfan and I lead the distribution team at Perennial. At Perennial, we've been investing in small and microcap companies since 2002. Alongside me today, I have Andrew Smith, who's a portfolio manager and head of the small caps and microcap business. You'll see him on the slide there. And also with me is Ryan Son. He's an equities analyst and he will be also working on this new fund. This fund has come about after a successful launch of the Microcap Opportunities Trust, which we launched in early 2017. It's exceeded our expectations, both in returns and flows. The fund has generated almost a 74% cumulative return since inception, which is February of 2017 to the end of May of this year. And as a result of that, as we always envisaged and communicated to our investors, the fund would be closing around the 150 mil mark. That will be happening at the end of this month. Just some quick housekeeping before I pass on to Andrew Smith. You're all muted, which means that you can hear me, but I can't hear you. On the bottom of your screen, you'll see a navigation bar which will allow you to ask questions. Just type them in whenever you're ready, and we'll address those towards the end of the presentation. And we'll make sure that we address all those questions. So on that note, I'll pass on to Andrew Smith.
Thanks, Caesar, and thanks everyone for the interest today. Just to give you some background as how we got to launching this fund. In a similar sense to when we launched the Microcap Fund, the background for that was small companies products been going since 2002. Throughout that period, we invested quite a lot in the microcap space, but we felt we weren't taking full advantage of the opportunities we were seeing. Hence, we wanted to launch a dedicated microcap fund, and Caesar's given you the background there. We'll be closing that fund to new investors at the end of the month. When we started the microcap fund for the first time, we carved out an allocation to the pre-IPO space. So in the microcap fund, we were able to allocate up to 20% of our fund to pre-IPO opportunities. Pleasing to say that since we started looking at pre-IPOs in earnest more than 2 years ago, the depth of the opportunities is much better than what we thought when we initially set up the microcap fund. So much so that in a similar vein, we think now having a dedicated product focused on pre-IPOs will take full advantage of the opportunities we're seeing. And you'll see some examples of pre-IPO opportunities that we've invested in through the microcap fund, and that should give you a flavour of the sort of investments we'll be looking for with this new fund. Caesar touched on those numbers for the microcap fund. Clearly, the more recent numbers have been boosted by some of these pre-IPO opportunities coming to market, and all these numbers are net of fees. Pleasing also that we've been acknowledged recently with several awards for the microcap and our small cap fund. And it will be the whole small cap team doing the analytical work for this new fund, but myself and Ryan will be leading the investments selection for this new fund. Ryan in particular, who I'll be handing over to, has experience in structuring pre-IPO deals. These are quite different. There's typically convertible notes, ratchet clauses and coupons involved. So Ryan's particularly getting involved in sort of maximising our returns, but also limiting our downside from these pre-IPO investments. And I'll let Ryan elaborate further on some of those structures. The fund's going to be structured to have 3 buckets. The 40%, as you can see on the slide, will be in pre-IPO opportunities. So these are stocks that are likely to list within 3 to 12 months. There's typically a date roughly penciled in by the company, and more than likely will invest via a convertible note. What that means is we'll be getting a set discount to the ultimate IPO price. That means that these investments can move up and down with the market. We're not taking a fixed price risk. So if the market falls 20%, 25% discount, for example, will move with that new price. So we quite like that structure for convertible notes. In the listed space, we'll only be looking at brand new IPOs or discounted placements. So we won't be buying any stocks on market, just participating in new fresh capital coming to the market. So that's 30% of the proposed fund, and that will be turned over reasonably regularly each year, whereas obviously the pre-IPO and the unlisted expansion names will be a much longer holding period. the unlisted expansion and growth capital. These are stocks that are 12 to 24 months away from a likely listing or trade event. Typically, we'll invest on attractive valuation terms. There won't be a set date in time for exit, but we'll work with the company then to make sure they've got the best board and best structure and maximise their growth before coming to market. So that the holding period for this group of companies will be much longer. I'll just hand over now to Ryan to run you through some recent examples to hopefully give you a better sense of these type of investment opportunities.
Thanks, Andrew. So the first example I'll run through is Ecofiber. This is a good example of investment we made at an unlisted stage, which we then followed through to the IPO and still hold today. So just briefly, Ecofiber is an industrial hemp business. They have 3 business units. The first is Ananda Professionals, which think of that as your Blackmores in the US. So selling to pharmacies, hemp oil that can be used for sleep or anxiety. Ananda Food, which is their food business. So this is your hemp proteins and hemp oils, which is based in Australia. And Hemp Black, which is a technology style business in which the company owns a patent over the supply chain of getting hemp into textiles with numerous benefits such as anti-wicking, antibacterial, and conductivity properties. So to run you through the process of how we came to this investment and why we entered at an unlisted stage, the company was initially introduced to us through our broad sort of network. Firstly, one of Andrew's contacts who works at a broker firm approached us that there's an opportunity to invest in this business via the fact that the original founder, who no longer has day-to-day responsibilities within the business, is selling down some of his shares. Contractually, he had to be under 20% of the company at the time of the IPO. Further to this, Barry Lambert ran into John Murray and suggested we have a look. So we initially looked at this company when it was at 57 cents. At this time, it wasn't federally legal in the US hemp wasn't federally legal in the US. It was legal on a state-to-state basis. However, all signs are pointing towards the fact that it was likely to become federally legal. Senator O'Connell, who is based in Kentucky and who knows the operations of Ecofiber well, was in fact the person who passed the Farm Bill. So at this time, we were willing to take an unlisted investment using straight equity, as the upside potential was potential multitudes of that opportunity. At this stage, the downside risk was also fairly limited in the sense that the business still had their food business, which is based in Australia, and this was revenue generating. As you can see, if you follow the timeline there was a repricing event at 65 cents. This was a third-party transaction in which a strategic investor invested into the Hemp Black business. That at this point in time, we were able to rewrite it up to 65 cents as there was a tangible repricing event. We'll always hold these investments at cost until there's an opportunity, until there is an investment made by a third party or there's a tangible transaction. We then followed our money at the IPO. At this stage, the company had no broker coverage. The prospectus they only had historical financials and the Farm Bill had passed. So it was now federally legal to sell hemp within the US. And this, by nature, was going to sort of increase opportunities by magnitudes for the company. In their latest sort of announcement, they suggested that the revenues will be 5.5 times larger than FY18. The IPO was mainly open to retail investors. However, we managed to get a decent allocation due to the fact that we had built a relationship with the company. And we still hold this investment to this day. The second example I'll run through is Atomos. This is an example of a company that we invested in at the pre-IPO stage and then followed our money at the IPO. So very briefly, Atomos is it's a camera technology that sits on top of video recording video cameras, so your Nikons and your Canons. They have an extremely strong position in the semi-pro market. Simply put, it's a camera that's probably double the size of your iPhone that's got extremely high resolution, so you can see what you're recording in live real time. It pulls the raw data from the camera and has a hard disk at the back. This enables you to save time at the editing stage, which in turn can save businesses lots of money. So we were introduced to this company through a corporate advisor. It was a pre-IPO investment that had quite strict timelines in terms of when the company was going to IPO. If they didn't IPO at this stage, then there was different ratchet clauses in place which increased our discount. So at an equivalent price, we had a 20% discount with a 10% coupon, and this made our pre-IPO investment 30 cents. The company had to basically IPO within the December period, and as a lot of people are aware, this was quite a tough time for the equity markets, particularly technology companies. If they didn't IPO at this stage, that discount would have increased further. So at this point in time, the company wanted to IPO at 65 cents. However, given where the markets were at, we pushed valuation exceptionally hard and suggested that they use a tangible, profitable number to base the IPO on, which turned out to be a 3 times EV to gross profit at 41 cents. The benefit of this is that we were still converting our pre-IPO investment at a discount to this price. So in essence, we were moving with the market. Since that point in time, we've held the company, and it upgraded last month. The other interesting point to note is the escrow swap. So this is something which we will look to do more of. We took on someone else's escrow at a deeply discounted rate of 60 cents, while the spot price was $1.07. I'll pass you over to Andrew, who will talk through Uniti, which is a great example of going through from unlisted to pre-IPO and then into the IPO.
So investment in Uniti started with the management team, which was the founders at the time, coming to talk about a pretty unique business model. Basically, this was a business model that was going around NBN. So it was fixed point-to-point wireless. So think about it as effectively microwave dishes on your roof, going from building to building. So they sort of spread out from a central point and build that infrastructure as they expand. They've done a good job in Adelaide, where the hometown was. We read a lot of customer reviews at the time, and there was glowing reports about the customer service of Uniti and the speed of access. So we thought there was a great long-term story here with the rollout, obviously going beyond Adelaide to Melbourne, which they'd already had a presence in, and then down the track, Sydney, Brisbane, Perth, for an example. So we made a very small investment at the time at a fixed equity price. At that point, there was no firm IPO plans in place. They were developing their more longer-term plans. As the months progressed and we continued to engage with the company, suffice to say we were a little underwhelmed by how aggressive the founders wanted to be. They were very strong technically, but we felt perhaps commercially they weren't driving the business hard enough. So we were supportive of a new chairman coming in, very experienced telco chairman, who also appointed a new managing director, Nick Simmons, who was known for us from SP Telemedia, which became TPG Telecom, and many of you will know how successful that investment has been, and particularly for the small companies fund. So at that point, we encouraged the company to take a bit of a hit on the initial investment. It was only a small investment for us. We really wanted to set this up to be an excellent IPO for everyone, and we wanted to participate in quite a substantial way at the IPO. As you can see through this repricing, so we've had both an equity investment at 59 cents, a pre-IPO that worked out at 16 cents, and then we invested more at the IPO at 25. That delivered an average entry price to us of 22 cents. One of the founders of M2 Communications came onto the board shortly after listing. The market was initially confused as the founders left the business, but this was obviously part of the plan. And the share price has responded strongly since there's been some M&A by the current management team, and Vaughan Bowen, the founder of M2, has come on and bought stock on market, which is obviously a great signal. So this stock is now up more than 5 times from our average investment, so it has been quite a good investment for us in the pre-IPO space. And it's a good example of us following our money through all the 3 stages that we invest across. And just to remind you and give you some live examples of these 3 stages. So Uniti Wirelss started off on the left as an unlisted expansion and growth capital. It then progressed to pre-IPO, where we applied some more capital. And then it progressed to an IPO, where again, we provided some more capital. And that sort of informed the thinking for the three buckets we're going to be investing in with this new fund. You can see some examples of the investments we've made here. These are every deal we've done in the microcap fund over the last 2 years in the industrial space. So we won't be doing resources in this new fund, given the amount of time and the lack of liquidity. We want to focus on growing industrial companies for this fund. There's some bullet points you can see below those returns, but basically these are the actual average returns from each deal. On the left-hand side, this is the least liquid part of the market. These are the positions you're holding for a year and a half to 2 years. So you would expect the returns are higher on the left-hand side. And as you get towards the more liquid end of the market, the IPOs and placements, as you'd expect, the more liquid they are, the lower the return. So that you're getting compensated on a risk-return basis. So that's exactly how we'd expect that return profile to play out. I would say that returns of these magnitude would be hard to replicate, but they are indicative of the sort of opportunities that are out there. And if you read the footnote, you'll see that we're actually carrying, on the left-hand side there, in the unlisted expansion capital, we're actually carrying a number of deals at cost. So they're coming through at a 0% return. And clearly the two deals, Ecofibre and Uniti Wirelss, have been very strong returns, and that drags up the average. To better match up liquidity, this will be a 5-year fund. We will be handing back all the capital at the end of the 5 years, but there's no opportunities to take out capital or sell your units until the end of that 5-year period. The reason for that 5-year lockup is to match up appropriately liquidity with the growth profile of the company. So you can see here from this slide that the investment period for each stage matches that appropriately. So over the first 3 years, we'll be making those investments in the unlisted expansion and growth capital. We then spend the next 2 years gradually exiting those positions opportunistically. In the pre-IPO space, that investment period is 4 years, as you'd expect. And then the IPO in placements, obviously, we can go right up towards the end of the 5 year because they're very liquid. In a matter of weeks, you're getting liquidity out of those investments. One thing you'll also notice there is, unlike some of the traditional private equity structures, we will be delivering realised returns back to our investors each year. So, for example, if we make $120 and 10 of that has been realised, so actually sold on market, then that gain will come back to investors. So there will be some form of capital coming back each year. And clearly in the 5th year, all the capital will be coming back. I'll now hand back to Ryan just to talk about more broadly about the fund and then run through some of the attributes we're looking for in each investment.
So some of the benefits that this space has is, firstly, this isn't a space that's it's well serviced by typical institutional mandates. The reason for that is that they're not liquid, so you can't buy and sell on market, and so therefore, if a fund is doing it, they typically only have a very small proportion of this in their fund. Secondly, and this is probably the key benefit that we think we have, is leveraging Perennial's value, Perennial's scale and access. And one of the keys behind this is the fact that we have the whole small caps team and the smalls and micro sitting behind this fund. So, and to illustrate, there's 2 conversations I've had this morning, is corporates really wanting Perennial on the register because they know this gives them optionality to go to an IPO. So as a result of this, we're able to really structure and put together favorable terms for our unit holders, whilst also providing the company with a great brand on their register. The third benefit is that we're not taking investments at the seed or sort of Series A round, so we're avoiding extremely early stage risk and idea generation. I'll touch on that in a second. Lastly, another benefit is our ability to structure deals to, 1, try and maximize the returns we can generate. So picking what structure we want for which investment, and 2, trying to minimize as much downside risk as we possibly can. So this graph just shows where we invest. On the left-hand side, we have seed and venture capital. So these can be ideas or family and friends. The typical VC firm is the 80-20 rule. So they're trying to generate 80% of return from 20% of their investments. We're going to play more in the expansion and growth phase. So this is where companies have a demonstrated business model. They're generating revenues. However, we think that with more capital, they can really expedite or grow the business further.
And as an example, we're looking for companies that are doing between 3 and 5 million in revenue, but obviously growing very fast. So we do have a minimum revenue threshold when we're looking at investments.
So we have a fairly strict approach to investments that we like. Firstly, we're looking for extremely strong management. So this management either has done this before, they're incredibly passionate and they have deep domain expertise. And the other thing is they need to be heavily invested themselves. Secondly, it must be a demonstrated business model with existing revenues. So like Andrew said, we're looking for companies that have got sort of $3 to $5 million of revenue, and with some more capital, this could really go further. We're looking for businesses that are scalable and have global potential. So we're really attracted to businesses that have a pretty big operation in Australia and are starting their offshore expansion, and they can do this with a fairly capital light business model. As just by nature of where the market is, companies are staying private for longer, and we're seeing enormous amount of deal flow. We've seen more than 200 or 250 deals since we've started this, and this is only going to increase. I'll now pass over to Caesar just to run through the offer summary.
Caesar here again. Just to wrap up in terms of the offer summary and a quick conclusion, then we'll open it up for a few questions. So the investment manager, Perennial Value. Perennial Value's been around for quite a while. As an organisation, we've been investing money since 2000. A very substantial firm with $5.5 billion under management. This is a 5-year opportunity, and the reason it's 5 years is we need time to be able to invest in these companies and obviously capitalise on that private to public premium. Our microcap trust has daily liquidity, which means there's only so much we can allocate to this pre-IPO space. We're looking to raise between 50 and 100 mil. We have a strong cornerstone investor in Morgan Stanley. We anticipate that the offer will close sometime in late July, early August. We've talked about the fund objective and the portfolio. All the capital will be called up front and will be put to work from day one and deployed over the next 6 to 12 months across the 3 buckets that Andrew and Ryan talked about. I'll emphasise again that this is an opportunity only for wholesale investors. What does that mean? In essence, if you invest $500,000, you automatically meet the wholesale investment test. If you want to invest less than that, we've got a minimum threshold of $100,000. In the application process, there'll be a certificate that you need to get signed off by your accountant stating that you meet the sophisticated investor rules that are based around minimum personal income per annum or minimum assets. They're fairly straightforward and common rules. So your accountant will be able to, if you're not familiar with those, your accountant will be able to sign off. The management fee of 1.5 is not too dissimilar to what we charge in the microcap trust, which is 1.2. Keep in mind that all the costs, there are additional costs in managing this strategy. For example, the valuation of assets, legal costs and due diligence. They're all captured within that fee, so that there are no fees up and above that. There are no expense recoveries. The performance fee, just to explain it simplistically, basically it's a 20% fee above the hurdle of 6.5%. Now that hurdle is after we've paid ourselves a fee. So in effect, on a gross basis, we need to generate a return of 8% or greater to be entitled to that performance fee. The reason we're paying ourselves some of the performance fee along the way is that as we crystallize capital gains throughout the life of the investment, rather than reinvest those like other fund managers, it will distribute those. So as we distribute those realized gains, if we outperform the hurdle, we'll in effect pay ourselves half of that performance fee, with the balance being paid at the end of the term. Now, this hurdle is also compounding as opposed to an absolute hurdle every year. So it compounds every year, so the hurdle rate goes up. I already mentioned annual distribution. So in effect, you'll be getting your money back as the investment progresses. No redemptions, it's a lock-up fund. I talked about the wholesale investor test as defined under the Corporations Act. Service providers are best in breed, so Mainstream will be the fund administrator. We've sought legal advice from Minter Ellison, and the tax advisor is Ernst & Young. So on that note, I think I'll just jump to the conclusion. A very exclusive opportunity, in effect, which is what in what has become a very attractive asset class. There seem to be a lot of fund managers out there investing in the private equity, venture capital end of the spectrum. This is obviously the deals that are a little bit more progressed, and we've found that there's just a lack of capital in that space, and a great opportunity for a manager like us that's got a track record and well resourced to capitalise on that private to public premium. Very experienced team, been investing in small caps and micro caps since 2002. The Perennial Value name certainly gives us scale and access, and a very long established network out there on the street. A proven track record, so we're not new to this. We've been managing the microcap fund now for over 2 years. We have limited capacity. As I mentioned, the offer, we expect the offer to open next week. We're just putting the final touches to the information memorandum, and we expect it to close late July. So first investors in essence. Now we've got some questions here. First question, what happens if oversubscribed?
We do have the ability to close the raising earlier, so we won't be going past 100 million cap. And obviously we're giving priority to investors that have come in first. They'll get full allocation. We'll close it once we reach the 100 million target.
We have another question here. What happens if unable to exit investments at year 5?
Yeah, that's a great question. Obviously something we've spent considerable time on. Clearly that's more likely to happen in that first bucket we spoke about. You can see that we've limited the investment period for the first 3 years, so we give ourselves 2 years in which to exit. In reality, we're going to be making most of those investments probably in the first year and a half, so we're giving ourselves lots of time. And at the very first meeting with management and the board, we talk about exit plans. And we monitor those exit plans through the life. We do have various options, but everything's structured to try and make sure that we've exited those investments by the end of 5 years. The fund will have flexibility. If there's one asset, for example, that's left, there's several options we could have. If it's in the best interest of all unit holders, we could transfer out to our existing listed funds. If there's an asset that is maybe only 6 months away from IPO, we could in specie that out to our existing unit holders. But that's really going to be an exception. Every investment is structured so that we've got all the liquidity back at the end of the 5 years.
Another question here. What happens if IPO markets significantly shut over the next 5 years?
And another reason for having a 5-year fund is so that we've got quite an open window. I've been through many market cycles. There's not many cycles that have lasted the whole 5 years. Interestingly, if the markets do dip, like we had in the December quarter last year, we actually made our best returns through investing during that downturn. If IPO markets shut, clearly a lot of potential investments for IPOs walk away. We're able to get much better pricing for our investments. And as you can see through Atomos and Uniti Wirelss, we're still able to get those stocks to market and have been very successful. And that's despite listing in probably the worst time for those potential investments. So there will be periods more than likely over the next 5 years where the IPO market's going to be tough. We actually think that's to our advantage. We also have a plan B in place for every investment we make. So we talk about IPO as a potential exit, but literally at the first meeting, we're talking about who are the potential corporate targets, so we can have a trade sale of these businesses, and we speak to management about that, and we'll actually actively go out, and we're already doing this with some of our investments, build up an interest from a trade sale point of view. So we do have a backup option should that IPO window be closed for a material amount of time.
Yeah, I'll just add a little bit of colour to that as well. So with the unlisted expansion and growth capital, with that part of the fund, we're typically going to invest using straight equity. The reason behind this is that we see these as extremely fast-growing businesses that should be worth magnitude of what we're investing in. This often becomes quite attractive from a trade sale perspective. So it does give great optionality both from the IPO and trade sale. Then if we're doing a sort of traditional pre-IPO where we're using a convertible note, we really like these structures because we're typically moving with the market. So if the market's going up or down, we're converting accordingly. And if the IPO market does just shut down and there's no IPOs, our discount will materially increase. So we're basically getting a much larger upside, which will convert to the next price, which could in essence be a trade sale in its own right.
Thank you, Ryan. We have another question here. Given the liquid nature of some of the investments, how are these assets valued?
So everything's going to be valued, everything that's unlisted is valued at cost until there's an event. So you saw with Ecofiber, there was a significant investor from the supply chain in the textile business that came in, paid a higher price than us. And only at that point, once we had evidence of that transaction, did we write that asset up. And the next point was at the IPO. So once the IPO was firm, we then wrote it up to the IPO price. And obviously once it's listed, that's much easier. It's just measured off the listed price. We will be providing a unit price monthly and then a performance fee assessed annually. So very conservative approach to valuing these assets. We'll be just carrying them at cost until there's evidence of a change. And that can be up and down. As you saw with Uniti, that actually went down initially.
And Andrew, this is my understanding in line with best practice.
Yes.
Well, ladies and gentlemen, on that note, we might just wrap up. Thank you again for dialing into today's webinar. You will soon receive a copy of the presentation and also a copy of the information memorandum. There'll also be a link for online applications, and we expect the offer to officially open next week. And as I mentioned, close at the end of July. So once again, thank you very much. All the best and have a great day.